You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
It is a dangerous world out there. Volatility is on the rise and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews with leading advisors, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. And now, it's time to arm yourself with the latest weapons in the war on risk. It's time for the Advisor's Option.
All right, everybody, welcome back to the Advisor's Option, the program here on the old Options Insider Radio Network for you, the busy asset manager, the busy financial advisor who wants to learn more about how you can incorporate options into your client portfolios. My name is Mark Longo, beaming to you live here from the Options Insider Studios here in actually quite sunny and scenic Chicago, unseasonably so for this time of year. If you do hear a little bit of banging or whatnot in the background, listeners, I do apologize. We are in the process of upgrading here in the old studios, but thankfully we'll try to keep it to a low roar during showtime. And as always, of course, if you're listening to this show and say, how can I check out some of the great guests and other topics you guys have discussed on the program in the past? Well, no shortage of ways for you guys to do just that, including surfing on over to the mothership, the flagship, theoptionsinsider.com. While you're there, of course, you're free to do anything you want. Click on the radio network, of course, tab on the top left corner of the page to stream and download all the archive episodes of this or every other program on our network. Read our breaking news feed, educational, analytical articles, trading analysis articles from the world of options. No shortage of content for you guys to there enjoy and chew on. And of course, if that's too much for you, you just want to grab the radio, surf on over to iTunes, TuneIn, Stitcher, wherever you grab your favorite podcast programs, even, of course, our own mobile app available for iOS, Android, and the Fire OS. No shortage of ways for you guys to grab a hold of the Advisor's Option program and really sink your teeth into it. And of course, when you're doing that, send us your questions, your comments, your feedback. We'd love to hear from you guys. In fact, quite a few of you have done just that, and I feel like we've been remiss in addressing your questions. So we're going to get to as many as we possibly can today. But before we do that, let me introduce my cohort here, my partner in crime on the Advisor's Option program. He is the co-founder of Swan Global Investments, Mr. Randy Swan. Randy, welcome back to the program, sir.
It's great to be here. This is the time of year where I actually wish I was back in Colorado due to the fall coming along and the changing of the colors. Cool, crisp nights.
Yeah, I'm guessing in your new Swan HQ down there in Puerto Rico, you don't really get much seasonality.
Version of 80 plus degrees at all the times.
I suppose there are pluses to that as well. So yeah, to each their own. But yeah, nice. I tend to be with you. I'm the kind of guy who likes a little bit of seasonality with his seasons. It tends to help delineate the passage of time. And speaking of passage of time for us to get on with it. With our first segment, it's time to dive into a really quick The Buzz segment.
Busy financial advisors don't have time to follow the latest developments from the options market, so we do it for you. It's time to get The Buzz.
All right, listeners, welcome to The Buzz. Like the man said, this is the portion of the show where we update you on all the breaking news and developments in the world of options that pertain particularly to you guys out there in the advisor asset manager realm. Before we get to that, though, really quick, let me introduce our late addition to the program. You know him from our previous episodes, Mr. Mike Cavanaugh from RCM Wealth Advisors. Mr. Mike, welcome back to the Advisors Option Program, sir.
It is great to be back. Thank you very much. I know there's been a lot of activity here in the market, so it should be a good show.
Has something been happening? I wasn't aware. Has it been a turbulent period in the markets? Are you implying that something is afoot?
There's been a little volatility, yes.
a little bit, which hopefully is interesting for you guys in there tuning in the listening audience, because it is interesting time to be in the world of options. But before we get to all that, and indeed your questions, let's dive on into the buzz. If you guys heard our last episode, of course, we had Joe Corcoran from the OCC. He is their counsel over there in Washington. He is the man to go to for all things Washington related when it comes to options and derivatives. And he kind of gave us an update, a somewhat alarming one, on a proposal before the Department of Labor that would effectively eliminate the use of options from IRA accounts, which, as we know, is a huge use case for the options community as a whole. About 15% of ADV, they estimate, comes to IRA usage, but particularly for this audience, for the advisor audience, it is an enormous use case for options. I would probably say the majority of it goes into a lot of retirement-oriented accounts. So if this proposal were to go through, it would have significant impacts on, indeed, the audience for this program. And so I wanted to kind of just remind you guys quickly here at the top of the show. We talked on it last episode, but the period for you guys to add your 2 cents figuratively and literally to this proposal, your own comment letter, is running out. I believe it expires very soon on the 24th. Hopefully this show will be up in time for you guys to do just that. If you want to add your 2 cents, you want to chime in, and quite a few people have been writing to me asking how to do just that, so I wanted to make sure we reiterate here on the show today. You can go to a couple of different places to do that. You can go to, of course, theocc.com. There's a link right up there on the homepage. The OCC, of course, the Options Clearing Corporation, the parent company of the OIC, the Options Industry Council, who are indeed our good friends on this program. That's one place you can go if you want to go straight to the source. Write this one down or maybe rewind the show a little bit. It's a little bit longer URL. It's the Department of Labor, so it's dol.gov, and then it's /EBSA, then it's /regs/conflicts of interest. .html. So that's not too bad of a one. If you want to go straight to the horse's mouth, register your own thoughts on that. That was indeed on the conflicts of interest exemption, which could, if passed as it stands, could essentially eliminate options for advisors out there in retirement accounts. Now, Mike and Randy, I know we talked about this at length on the last episode. It's kind of just grown in furor, at least for us here on the network, people writing in from all walks of life with interest in and concerns about this, which shows how far-reaching the use case for options and retirement accounts is. I'm curious, since the last time we were able to gather together here on the program, have you guys heard a lot of reactions from this, from your clients and your audience? Maybe, Randy, we'll start with you. Have you talked to other advisors who are concerned about this, and what's your take on how things are progressing so far?
I think there's a lot of outrage and concern. I'm not sure how serious the government is about imposing this limitation, but as it relates to SWAN personally, yes, we do have a lot of advisor programs that use our SMA program with IRAs. So this would be a bad scenario for us in that case. But like I said, I'm just not sure if after the comments have all come in, if they just was a oversight on the part of the Department of Labor, or this is something that's more active they're trying to actually prohibit going forward.
Yeah, and as you'll recall, that's something I tried to get at with Joe on the last episode. Was this a kind of malice of omission there, or was there some actual malice there in terms of someone really having an agenda to eliminate options? I can't imagine the latter being true, but he wasn't so sure. He wasn't so sure which way it fell on, and it's kind of hard to intuit intent when you're talking about what's going on the Hill and various related governmental agencies. So like they're supposed to, those guys take all these threats very seriously. I kind of hope, like you, Randy, that it'll all kind of go out with the bathwater at the end of the day, that they'll realize I'm assuming the overwhelming number of comments on this will be a negative and that people will not want this. And so hopefully they'll realize the error of their ways. But I've been wrong before when it comes to regulatory developments, so I'm not going to take anything for granted. Mr. Kavanaugh, same question to you. You interact with a lot of advisors as well as a lot of retail clients. I'm curious what the feedback has been from those groups, from your experience, and what your own personal take is on this now a month later.
Yeah, I mean, it's the same thing Randy said. It's a head scratcher at the very best. When I first heard about it, as a proposed rule change, I haven't met one person or talked with one person that said they support this and they think it's a good idea. So, I mean, both Randy and I are on the advisory council for the OIC, and we recently had a quarterly conference call. I know that we had Frank and Eric on the show last time here talking about this proposed rule change, and it really is a head scratcher. I've read it. I don't understand it. I don't understand what they're trying to protect, so to speak, by not allowing, this to happen. There are a number of exemptions that they write about, so I don't know if it's perplexing to me. I'm kind of in the camp with Randy. I don't know how serious they are about this, but I think we'll start finding out. I would imagine there'd be some pretty upset people if it were to go through that they would rally around it. But there's been a lot of people talking about it, a lot of people sending letters to their elected officials about not letting this rule change occur. So anything could happen. I would be shocked if it were to go through, but if it does, I think the people that are sending these letters are going to be even more upset, and you'd see some kind of not like a sit-in or a protest, but some kind of backlash coming from the investment world. I don't think this would help anyone.
I like that. I like that imagery of a sit-in on Capitol Hill to protest for options. I can imagine how that would go over in the general public eye. But you're right. I kind of hope that and pray along your lines that you guys are indeed correct. Maybe it's the diehard cynic in me that has me a little bit worried. But c'est la vie. I'm looking at it right now again, and if you go to theocc.com, probably the easiest way for you guys to voice your opinion. There's a big banner right there in green on the top right of the homepage. It says proposed rule to ban options in IRAs. Learn more about the rule and voice your opinion. You click right there, and it'll tell you pretty much how to do just that. It provides a link. So if you don't want to go back and copy down that extensive URL I gave you a little bit earlier, that's probably the easiest way to do that. And I'm kind of with you, Randy and Mike, as well, on that. It does seem like an oversight. If you read the exemptions, what they allow, things like annuities, of course, we all know here, annuities, many of them incorporate derivatives in some form. That's how they're able to generate those types of returns. So you'll allow an annuity in an IRA, but not the options themselves. It is kind of backwards thinking, which does lead me to believe that it was indeed an oversight. But don't take that for granted, listeners. Go voice your opinion. If for no other reason than these things are taken for granted, and then they end up going away, and then we miss them. And then in some cases, it could be very, very detrimental to your business. So if you don't want that to happen to you, then by all means, voice your opinion. Go to theocc.com and make your thoughts known to our friends there in Washington. Speaking of making your thoughts known, many of you have done just that. We've had guests recently, a lot of great debates, and of course, a lot of heated developments from the market to discuss. There hasn't been a lot of time for you guys to air your thoughts on the old program. So we're going to do that today with an extended deep dive into the office hours. We're going to get as many as we can of you guys featured on the old program. So here we go with some office hours listener mail.
It's time to answer your pressing questions about options. It's time to start our office hours. You can become a part of this segment by leaving a question on theoptionsinsider.com, emailing us at questions@theoptionsinsider.com, or via social media at twitter.com/options, facebook.com/theoptionsinsider, or stocktwits.com/optionsinsider.
All right, everybody, like the man said, welcome to the Office Hours, the portion of the show where you guys get to send us your questions, your comments, your insights to share with us, as well as with your fellow Office Hours listeners and advisors, options listeners. I love the questions you guys send in, because they do run the gamut from very, very intense and very, very high level to some more basic stuff and everything in between. So we love the full array of questions you sent in. Starting off with one here. This comes from Tom V., Mr. TLand66. He writes, "Hey, I would like to submit a question for the Advisors Option Radio program." Well, you sent it to the right place, Tom, so you've already succeeded there. He goes on to write, "I've reviewed a wide variety of options products for my clients. Aside from large, widely held products like SPY and the Qs, there seems to be a surprising lack of liquidity in many of the products that I research. Spreads are wide and size is relatively limited, particularly in my preferred time frame of 2 to 3 months. My strategy is 4 to 5% out of the money covered calls. I don't want a substantial amount of size. 200 to 300 contracts will typically suffice for the needs of my clients. Still, this seems to dramatically outstrip the available bid in most calls by several orders of magnitude. I have to sell through the bid, sometimes by a substantial margin, to complete my transaction, costing my clients substantial amounts in slippage. After all, a 10-cent hit on 300 contracts amounts to $3,000. A quick lesson on multipliers here from Mr. T-Land. He goes on to write, "Hey, if I do that on every trade, it adds up fairly quickly. Do you have any tips that will help me find more liquidity or help me improve my execution on behalf of my clients? I find your program tremendously informative. I particularly enjoyed the episodes on the VIX and income trading, although I found your most recent episode discussing the issues with IRAs to be extremely alarming. I am drafting my comments on the proposal as we speak." Well, glad to hear you're doing that there, Mr. T-Land. Go to the URL I mentioned earlier if you want to do that. Go to the OCC.com, and that's a great way to do just that. Also glad you enjoyed our episodes on the VIX and income trading. You guys can find those as well in our archives if you want to dig deeply. And you guys, I'm exhausted just from reading that question. That was a pretty in-depth one. So perhaps I'll kick it off with you guys, let you guys talk for a second here. Maybe we'll switch it up. Mr. Kavanaugh, we'll start with you. What do you have to say with our friend, Mr. Veland, who's got a relatively common complaint that you get a little bit farther away from front month, farther away from at the money, and farther away from some of the more liquid products. And surprise, surprise, the bid-ask spreads widen out and liquidity starts to dry up in those strikes. What do you have to say for our friend here who's looking to remedy that?
Yes, and great question. It's one I wish, just as a wee little advisor, a pawn in this game, so to speak. I wish I had an answer where I could say, "Tom, check out these 4 tickers," and that should help. I think with Tom is basically, this might be somewhat therapeutic for Tom to write this question out. I think what he learned is stay away from the liquid options. That's got to be part of your decision-making process. And if you can't find an ETF, an index, or a stock that meets your parameters of liquidity, then stay away from it and stay in the SPY and the Q. You don't want to stretch into an underlying that you love and you want to sell some calls on and have $3,000 in slippage. Stay out of the illiquid options in those months. The only other thing I can say, and this just becomes a pain in the butt from a reporting aspect, is only using limit orders. But then you've got to, let's say you put 300 contracts out there and 118 of them get filled and the remaining 182 don't. Then you have to rotate first in, first out through all of your clients and the allocate. That's a huge pain in the butt. So I don't even recommend that. What I would say is, unless you're managing a fund, then definitely just use the limit order. But if you're doing separately managed accounts, like most of us advisors, in a covered call scenario, I think the parameter of saying I need X amount of liquidity in the options, X, whatever the delta on the option is, or I'm not going to trade that underlying and sell the calls on it. So maybe you are just playing in the SPYs and Qs, which isn't the worst place in the world to be. That's the best answer I can give you, Tom.
Yeah, SPYs and Qs are liquid for a reason. They are attractive. I'm looking here, he doesn't mention what other underlyings he's considering. I wish he kind of added that to give us a little bit more specificity so we can look it up for him and actually see what he's referring to. But that said, yeah, SPYs and Qs, not the worst place to be if you're managing a lot of portfolios. Randy, same question for you. You obviously encounter this issue quite a bit as you're constructing your overlays. What do you have to say to our friend here, Mr. TLand66?
Reasons he mentioned, we do stay in the more liquid options markets. I would like to maybe turn this from this potentially negative into a positive. I think there's some good aspects of moving to an index like that, namely not having an exercise risk of selling at the money calls. So if you're using a broad-based index like SPX or RUT or something like that, then actually you don't have that exercise risk. I think also one of the benefits of using a broad market index like that is that you get more favorable tax treatment since they qualify as Section 1256 contracts. So I agree. I'm not sure you can do something about the liquidity if it's not really there. I have a hard time believing that you can't come up with a solution that I think is probably better. And for us at Swan, we do primarily deal with the broad-based indices.
A second vote for the Qs and SPY there, Mr. Tom. So perhaps we have a trend. The only other thing I would add to that, in addition to seconding the Qs and the SPY, like I said, they're liquid for a reason. And if you go to something like SPY, I think you'll find decent liquidity about 3 months out. 4 to 5% out of the money is decently out of the money, but you'll be able to find something. I think you can probably get off some size. 200 to 300. 300 is actually, people think of, People think of the options market. We had a discussion actually on volatility views recently. People think everything is so deep and liquid. The actual amount of liquidity out there may surprise some people, particularly once you get away from front month at the money in products like this and Apple. That said, if you go into SPY or Qs 3 months out, you should be able to find decent liquidity. The other thing I would mention too, if you want to consider, and if you want to stay in whatever underlying you're in, again, you don't mention that, is perhaps migrating your liquidity on the covered call side a little bit closer to the front month. We all know as you get closer to front month, your liquidity will increase just by the nature of the beast. More people are playing in front month than they are every other month out there pretty much. So you can get a little more out there, as well as we know from an income generation perspective, and you can go listen to our many programs on income generation if you want to dive deeply into that. Of course, we know when you're playing on that front portion of the theta curve, the near exponential portion of the theta curve, again, it's a little bit different for out of the money calls versus at the money, but it all works out in the wash at the end there, where they tend to decay much more actively in that final few weeks. If you're playing in that narrow portion of the curve, front month, or God forbid weeklies, if you have the time and the patience for it, then you're going to outperform over the long term. It's going to be a little bit more work. Obviously, a lot of advisors don't want to write 300 or so contracts every month or even every week. They prefer to do it the way you do it every quarter from an ease of use perspective and everything else like that. But that said, if returns are the name of the game, and for a lot of advisors they are, you just look at any data on income generating strategies and how they vary depending on where you are at the call, including some of the stuff OCC has and OIC has done on their website. They have great data on that as well. You'll see that they dramatically outperform whenever you migrate your liquidity closer to the front month. So that might be a good strategy for you in general in terms of overall return. It'll help with the slippage and it'll help with the liquidity. So I think you may like to go that way as well, particularly if you're doing that in a more liquid product like the Qs and SPY. Great question. Kicking it off with a good one. We'll see if we can match that with our next one. Actually, this is the comment. Our next one comes from Steve A., goes by Hawkeye, and he writes, this is a comment on a study we discussed recently, the OIC study actually, about covered strangles, covered combos, I believe it was. He writes, with respect to the OIC's study on various option strategies since 2003, are you really surprised that the highest return was gained by a synthetic short put stupid in what has mostly been a bull market, and he puts in parentheses here, covered strangle, is equal to or greater than a short call plus a long stock. It equals a short in the money short put. Plus, out of the money short puts is a long way of him showing off his synthetic knowledge. So he's learned something. He said, yes, selling 2 puts brings in more money than selling 1. And he puts in parentheses here, the lobster and the meatball, who are 2 guys on one of our other programs, have taught me enough to figure this out, and they should feel good that something has stuck. Keep the great shows coming, Hawkeye. And then I wanted to mention this on this show too, because obviously this is where we discussed the OIC study at some length. And I wanted to say I wasn't particularly surprised by the outcome as much as I was surprised that OIC commissioned that study. I know in the past they've had some pushback from advisors and asset managers who weren't willing to discuss the concept of the covered strangle. That extra short leg to the downside really alarmed a lot of them, even some diehard income traders who like covered calls and maybe for whatever reason can't handle now what you clearly point out here, 2 short puts as opposed to just one. Again, a covered call equal to a synthetic short put. You're selling another put out there. You're doing essentially shorting 2 puts. That should outperform, I agree. And yes, that was kind of my main takeaway. I was happy to see that data is out there because in this, maybe not in this environment where volatility is a little bit lower, but earlier this year, remember things were a little bit quieter. Volatility is a little bit lower. It was difficult times for income traders in terms of being able to generate income. So any study that can help advisors learn about some ways in a risk manager's perspective, if they're okay with buying the underlying at that short strike to the downside, then it's a perfectly acceptable strategy for them. Then there's no reason why they shouldn't be exploring these additional concepts that go beyond the simple basic covered call. I mean, that works, but at a certain point, you maybe want to expand on it, and that was a great strategy for that. So my surprise was more along the lines of they were able to get a study like that done, that people actually responded to it the way they did. I thought they might run for the hills, saying, oh, no, a naked short leg, I can't handle that. But they didn't respond that way, which is always a good thing, and perhaps a little bit surprising for me. Maybe we'll switch it up again. Mr. Randy, what's your take on our friend Steve here? And essentially his comments in our discussion from a recent episode about the OIC study and just in general the outperformance of and perhaps the surprisingly positive response to the data on the covered strangle, essentially outperforming other things like the covered call and just a short put and indeed just being naked along the underlying.
Well, I think anytime you involve, I didn't hear what was said earlier, but my comments would be, I like selling puts. That's part of our strategy. So I want to get that full disclosure out there. But yeah, I think the saying, I think it was Mark Twain that says, why do you go out in the end of a limb to get the fruit? And he goes, that's where the fruit is. So I think it's the same kind of deal on the puts. I think there's a lot more meat in the put side because of the volatility skew. So yes, absolutely. It doesn't surprise me at all that that's how the profit that you can get from selling the puts.
Mr. C, anything you want to add here for our friend Mr. Hawkeye, who is deeply enamored with the selling of 2 puts, aka the covered strangle?
You know, the fact that in his response here he referenced the lobster and the meatball, I think two thumbs up, Hawkeye, wherever he is, for referencing Andrew and Mark in those terms. I think it's hilarious. Yeah, I mean, it's no shock, you know, that we've been in a bull market. Selling 2 puts brings in more money than selling only one. It's, you know, it's easy to say. You know, the thing about selling puts, right, is you have to look at the risk management involved, because I don't have the ability to know that we're going to be in a bull market for the next 2 years. So I have to be able to take on you know, the associated risk with selling 2 puts versus selling one. Hindsight's always 20/20. If you are a better forecaster in the market than I, and feel comfortable selling the 2 puts and can take on that risk, then I mean, I don't know an option person that would disagree with that statement. That selling 2 is better than selling 1 in a bull market, but it's always afforded by the hindsight of a strategy.
When in doubt, palms out, right?
That's right.
Nothing can go wrong with that strategy. Yes, an old floor aphorism for those of you who weren't around in those heady days. Moving on to another question here. This one comes from perhaps the appropriately titled noob question. This is a good one for you, Randy, because you do a lot of, you do sell a few options in your overlays. He or she wants to know, how does the premium selling work when selling options? Do I get the capital right away? How does that work from a margin perspective? We've had a few other questions on a similar vein to this, where people, I think, coming to options for the first time, they hear maybe a few of our shows, and they hear about these selling strategies, and they think of them, I guess, almost as sort of a funhouse mirror, where you could sell a put, collect that capital, turn around, use that as margin to sell another put, and keep going ad infinitum. And I think you listeners hearing that can probably intuit that is not indeed the case. But Randy, Why don't you illuminate our friend here about how it actually works when you sell that put, or in your case, sell that call? What happens to that capital? How can you access it, and how does that work from a margin perspective?
Before you can sell an option, you have to have a certain level of capital in that account, and obviously that capital would be based on what the brokerage firm may want from you. But as soon as you try to initiate an option trade where you're actually a seller, which means you're assuming the risk, you're collecting usually a finite premium in exchange for most likely a much larger risk. Obviously, the cash does get credited to your account on the initiation of the sale, but of course, they're going to go through a margin calculation that happens in real time on a consistent basis that ultimately makes sure that you have enough money in your account to basically pay that off. And so, let's say if we take an example of selling an index put, let's say that maybe like 5% out of the money, as the market starts moving down to the direction of the strike, the put strike, that margin requirement is going to increase. And so the margin mechanics is such that they're going to make sure that you have enough money in that account to pay off or buy back that put option at all times. Obviously, what happened maybe a month ago in terms of the market gapping down almost 1,000 points on the Dow would be an indication of that may cause a problem if you sold that put and you woke up the next day on Monday and said, oh my gosh, the market's down now 1,000 points on the Dow and maybe 100 points on the S&P. So that's fundamentally a problem with that kind of analysis. I don't think you can obviously multiply that type of ability to be able to sell those credits and leverage that up, because they're effectively going to use that credit and some of your additional capital. I think a good analogy would be an insurance company that writes premium. When that insurance company writes premium, they've got to put capital up, and they're typically going to collateralize the losses in addition to, or some level of losses in addition to into the premium that you're collecting.
It's a good point. That August 24th flash crash, sell-off, bounce, call it what you will, I think opened a lot of people's eyes to a lot of risks of selling puts, of indeed just working naked stop orders in the market, and a lot of other fun stuff out there. That was certainly an interesting day. We'll get to that. We touched on that a little bit, of course, last episode. Probably get to that more in upcoming episodes. But before we do that, Mr. Kavanaugh, anything you want to add here for our friend here who wants a little more insight into essentially premium selling and how that works once you sell that option and it hits your account?
Yeah, I mean, Randy outlined the exact, premise of it. The finite money that you collect for selling the premium, it adds to the cash balance in the account, but you should have set aside enough money in the account to cover what your, prospective margin should be. If you're using leverage, there's no perfect way to calculate what the margin rate may increase to based on the volatility, especially if you're using leverage and you're selling naked options. There may be an increase in the margin. So, the best form of risk management is to go through the scenarios of what you're, basically you could lose, and ask yourself if you're comfortable losing that amount before you actually put the trade on, and setting enough aside in the account to avoid the dreaded lack of margin call and forced liquidation. It's something that you never want to be a part of in any trading environment. So, just ditto to what Randy said.
Yes, not a call you want to receive, the old margin call. So short answer, Mr. or Mrs. Noob question, no, it's not how it works. You can't just sell the puts. Infinitely the margin, the capital hits your account, but you can't just run willy-nilly with it. All right, moving on to another, this is a comment here. Got so many, this is great. Comment from a listener goes by the handle Vox Populi. I like that. He or she writes, hey, great program. Well, thank you. I've shared it with a number of my colleagues because I agree that more fund managers and advisors should use options. You'd be surprised how many of those guys still look at me like I'm crazy when I tell them to buy a put. They prefer to save the money and rely on stops. So how did that work out last month? He says the exact same thing. Hopefully last month finally put that thought process to bed. What good is a stop order when the market opens down 1,000 points? Seems like these are great times to be a proponent of options. Guys like Randy must have their phone ringing off the hook from people who've seen the light. Well, a good comment. We were just discussing that very topic, so very timely of you, Mr. and Mrs. Vox Populi. And you're right. People have this notion, antiquated though it may be, that options are risk additive and just working orders in an equity is safe and a fundamental process for the markets. And they saw what happened last month when your market opens off 1,000 handles. That stop order you work in, that was risk. That was clear and demonstrable risk that you had on that you were not compensated for whatsoever. So people realize that now and hopefully are taking a little bit different tune. The flip side to that, of course, is a good argument for buying premium, going long premium, because on a gap down day when you have long premium in your back pocket, you can rest easy. You know you're covered at whatever strike you bought that premium in. Even if the markets are crazy or wild, you know you're protected. There may be some execution issues getting out. The spreads will be a little wider, so you may not get in every last cent of the value of that put if you want to sell it at the exact maximum height of the frenzy. But if you wait till things settle down a little bit, you'll get tighter spreads and you'll get a decent price. And you'll also have that added benefit of being able to sleep at night knowing you have the protection in your back pocket. Randy, he or she mentions you, so I'll toss it to you first on this one. What's your take on their comment, and has your phone been indeed ringing off the hook with people who have seen the light?
First of all, I couldn't probably say it much better than that. I appreciate the comment. I think it's absolutely true. I think you always start off from the premise of, can someone actually tactically time the market? Does their model work? Does their intuition work? At Swan, we don't really rely on that. We're really kind of anti-market timing people, as well as the anti-stock timing. So we fundamentally believe over the long haul, it's very difficult to do that. Therefore, yes, we like to buy the puts. We like to hedge all the time, always have exposure on the market, because fundamentally, even when you can make a rational case as to why the market's undervalued or overvalued, there's a lot of times long distances or long lag times between something actually happens. The example I always use is Greenspan in the late 90s talking about irrational exuberance, yet the market still took another 3.5 years after that comment was made to actually top out. So it's very problematic. And in fact, I was laughing about this because I was in Florida maybe 2 or 3 weeks ago talking with an advisor, and he made that same comment, like, oh, my risk management is about, lightening up on positions when I think the market's selling off. And I'm like, well, I can't really help you. I think there's a great line from Pulp Fiction that I use a lot, and I think it was Mr. Wolf made the comment. He goes, if self-preservation isn't a quality you possess, the best of luck to you, gentlemen. And I think that's all I can really say, leave about that, and let people that don't believe in structurally setting up a risk management program, there's nothing you can really do until they get burned and maybe change their ways. I do want to make one last comment, though. The big picture is, structurally, when you look at two different managers, if you're looking to hire a manager and one manager is able to systematically set in place good risk management protection by using puts, versus another manager that's tactically deciding when to get out of the market, when to get in the market, et cetera, which has a higher probability of success over the long haul, even if they have equal track records. I think the first one, where you're systematically buying put protection, is more superior to, we've all seen financial models and timing models blow up at the absolute worst time. So that would be my example. To answer your question about our phone calls, yes, we are getting a lot of phone calls about this. We actually have a good paper that we've just written. It's called A Summer Squall or the Start of a Hurricane Season. So we don't know actually what the sell-off in August was really. Is it the start of a bear market, or is it just a correction that occurs, on a frequent basis? It's too early to tell, but we always start off by saying there's risk out there. What are you doing about it?
Yeah, it is surprising, even in this day and age, people who are like the guy you just mentioned. I've encountered many of those types of individuals at conferences and events, and people who are otherwise, quote unquote, sophisticated from a market perspective, who are primarily long-only managers on the equities, and how content they are to ride the market up and then essentially ride it back down in these tumultuous things, and how they're reliant on essentially their own ability to stop it or stop themselves out or just go short or just to go flat in these types of environments. And of course, days like August 24th, how does that work out for you? The market's down quite a bit. They got lucky. It rebounded primarily in the subsequent sessions, but that's not always the case. So in those environments, there really is no risk management outside of owning a put. That's really about it. Unless you had the foresight to get short ahead of time, and who did that, then that's really kind of the only game in town. And so if you're talking to these people, or if you're out there paying for an advisor, listeners, who's not giving you this added layer of protection out there, then perhaps it's time to look a bit farther afield. It's a great comment. Anything you want to add there, Mr. Kavanaugh, to our friend's Vox Populi's comment?
Yeah, I mean, there's no real way to time a market. You either make the assessment that you're a long-term investor and you're willing to take on the swings of the market knowing what your investment horizon is, or you say, I'm not comfortable with the risks that are out there and I want to smooth out the return for my investment horizon by hedging using options. There's, if you look at options as a necessary insurance to hedge the risk in your portfolio, you can't time it. You don't know when the risk is going to poke its head up. You either make the assessment that risk exists and you want to hedge, or you don't. And there's really no way to say when the best time to do it is or when the worst time to do it is. It's coming to that realization that, risk does exist and I need to hedge it. And it's not for everybody, but, everybody in their investment life finds at some point their risk tolerance level. And, like Randy said, the phones do ring off the hook. And, no time is the right time, but if you want to hedge the risk, the best time to start is now.
Yeah, I mean, it doesn't take much more than the month we've had in the past month in the market to really be the best advertising there is for using options as some sort of risk management tool in your portfolio, because you've seen quite literally there are not many other options, pun intended, when it really starts hitting the fan out there. Hopefully you weren't caught on the other side of that, and hopefully your colleagues there, Mr. and Mrs. Vox Populi, survived the recent tumult with their portfolios and their clients' portfolios, more importantly, completely intact. Moving on, got so many. Let's see how many more we can get to here. Question here. This comes from Alan K. He writes, "Hey, I've heard discussion, in several outlets post August 24th. That would of course be the day of the big sell-off. That options can exacerbate market volatility, particularly at the beginning and end of the session. Is this true? And do you agree with this assessment?" This is an interesting one. We've heard this a lot in various iterations over the past few weeks. There was an article that got a lot of traction. People wrote into us a lot on Zero Hedge about options gamma and how that gamma hedging could impact the market. And there is, quite frankly, short answer, there is some truth to this. Getting aside from, the kind of the zero hedge tinfoil hat world of conspiracy theory that options are these great market movers. That's not really the case. That's very much overdone. That type of stuff, the impact on expiration Friday, those things kind of get overplayed a bit. But we do see some data on products like some of the big indices and others that some of the gamma hedging, particularly negative gamma hedging, can indeed cause some fluctuation, some increased volatility, particularly at the moments you described, like the end of the session. That's where we'll see some of that. So some of these days when you do see these somewhat apparently aberrant, movements in an index towards the end of the day, in the last 5 or so minutes of the day, some of that can be directly attributed at days and times, certain times, to options gamma hedging. It's not to say options are these great market movers, but studies have shown in aggregate they do tend on some of these big products that are widely held. There's a lot of like SPX, like SPY, like VIX, and others, where there's a lot of other products out there as well that have options or other derivatives listed on them, as well as ETPs. All of that order flow coming in at the end of the day, adjusting and rebalancing, tends to just cause a lot of fluff, a lot of furor, a lot of vol as a result. It's not just options, other products in there as well, of course, but all of that tends to feed into the whole and make those final minutes a little bit more volatile. So I would say yes, I do, but maybe not to the extent some people out there tend to look at options and point the finger at them for some great market moving culprit. But some products at certain times they have been shown to exacerbate things like end of day volatility. Mr. Kavanaugh, we'll start with you here. Anything you want to add here? And do you buy into this assertion that options add some vol at the end of the day?
I think it's hard to argue that they wouldn't. I think that, I don't think it would be the root cause. I think the underlying root cause is when volatility enters the marketplace in general. You're basically taking on a huge amount of emotion and uncertainty. And when there's a lot of emotion and uncertainty, there's a lot of rebalancing, portfolios at the end of the day and at the open. The open and the close are way more volatile in volatile markets, and larger orders that are tied to emotion and uncertainty are exactly, the definition of volatility. So the more volatility that's in the market, the more orders that come in, whether it's options, stocks, futures, any types of orders that are coming in on the open or the close in large amounts in a volatile market are definitely going to add to the volatility of the market. And, it tends to work itself over time. The more time you have, the more you learn about what's causing the volatility in the marketplace, and then things begin to settle down with time. So I don't know if exacerbate is the right word, that if options compound the volatility or whatnot. I think it's a yin and a yang relationship between any orders that go in on the open and close. And there is more volatility in the marketplace in general. The larger the orders near the open or the close are actually going to, yes, I would agree, would add to the volatility in the marketplace.
Mr. Swan, same question for you, sir. Do you concur with this, or do you vehemently disagree?
Sure. I mean, I would just say, for more of a general principle, any product that you trade has to have some level of effect on the market. And obviously, small trades are not going to have a big issue. But if there's big components of the market being traded by big hedge funds or big shops, then yeah, absolutely, it can affect it. But no more so than anything else. I mean, if I want to buy some put protection, maybe the market maker may be shorting some futures. So it's everything has to be taken into account.
I didn't mention this question too. It's very similar. I might as well give him some airtime as well. As comes from Musin. He writes, "Hey, Monday's market move, obviously from last month, was difficult to believe. Could it be that the huge options portfolios held by macro hedge funds are to blame for Monday's big move in the market? Doesn't this phenomenon also exhibit itself around options expiration?" I think we just touched on this one, Musin. So well timed on your part. They do play a part, but probably not as big of a part as some people believe. I think you're referring also to that Zero Hedge article. They did kind of point the finger at options gamma for perhaps having caused the sell-off. I don't think anyone here really buys into that argument, but they can have an impact. And I think that term they used before, maybe exacerbate, does kind of apply, because that is sometimes the effect they can have at end of day volatility. Good question. All right, let's see. We have time for a few more here. This one comes from Vivian. Got the ladies representing on the old show today. Says, "Hey, I came across this article recently, and I immediately thought of your program." Well, thank you, Vivian. She goes on to write, "Do you feel this information is accurate? If so, how should someone treat options that are deeply in the money? Are there any guidelines for when they should be exercised or how they should be treated in a portfolio?" Let me give you a little bit of background here, listener. She also provided a link to an article, which I took a look at. It was from February, I believe, of last year. So a little old, but still the data is relatively recent and credible. And it mentions, the title of it was "How Recent Stock Market Corrections Affect Employee Stock Option Value." So you can go search for that yourself on Google if you like. I believe the site that had it was something called Stock Opter. I'm not familiar with it. And they had some interesting data. They mentioned how, and also a very interesting graph, which we'll try to include on the show notes for you guys to see around the article on the website as well, so you guys can follow along. They say, essentially, even though at the time it was written, there was a little bit of a correction in the market, nothing as big as we're seeing now, but still a little bit of volatility in the marketplace. He points out in the article that, and probably rightly, that most employee stock options granted in the last 10 years are likely to be in the money, and he has a whole chart kind of illustrating that, because again, in the modern era of the Sarbanes-Oxley, the options are granted and strike price is issued when they're issued. So most of the ones that were issued around that time frame, given what we've seen in the market over the past better part of the last decade, except for, of course, 08, post-08 certainly, are in the money, and certainly ones granted in 08 and 09 could have even doubled. So unless they had some really bad misfortune to be issued at some top times, and even still, if they got issued in the peak before going into 08, they still are probably up money now at this point. And so she asked a good question. When the article goes on to talk about when should they exercise and sell your options in order to maximize your value, and she asked in her question, of course, are there any guidelines for when they should be exercised? At this point, if you have options like this that are deeply, deeply in the money that you've held for a long time, you should really view them not much as an option anymore. They're essentially stock. if you're 800, 1,000 handles in the S&P in the money at that point, yeah, you're sitting on essentially a future or a stock, depending on what you're looking at, if it's Apple or something else like that. And so you should treat it accordingly. I mean, if you would sell the stock at that level, then it's probably where you should come in and exercise. Granted, there's going to be tax considerations. There may be some limitations on when you can exercise, depending on your ESOP and when those options were issued to you and what the rules are, investing and all that fun stuff. But all that other stuff aside, assuming you are able to do whatever you want with these options at that point, you should view it as stock. There's nothing else really different than that. There's no real other appreciable component other than intrinsic value on those deep in the money calls. And so you should treat them like stock. And if you would sell the stock there, then yeah, by all means, you should be comfortable exercising those options. I thought it was an interesting question, guys. We don't get a lot of questions on ESOPs, but they are very important to a lot of the advisor community. A lot of people come to advisors looking for management with ESOPs and very concentrated risk positions in single companies. So this is probably a question that's on the minds of a lot of our listeners that we don't really address a lot. Maybe Mr. Kavanaugh, will start with you. Anything you want to add here on this notion of deep in the money options, what to do with them, how to treat them, and B, the notion that there are a lot of people out there, probably executives and others, who are probably sitting on some pretty deep in the money calls right now and what they should be doing with those.
Yeah, I mean, there's no real way to assess it other than like getting an example, but you'd have to check the restrictions in the ESOP. But if they're deep in the money, there's probably very little time value in it. The only benefit to like selling an option and buying stock would be is if there was a lot of time value. If it wasn't that deep in the money and you had a lot of time value, you could actually be better off selling the option and then buying the stock. Because of the extrinsic value in the option, but consider it. There was probably a good investment with the option, and if it's in the money, there's probably no reason not to exercise it.
Yeah, I can't imagine they're sitting on a lot of time premium on a lot of these things. Certainly nothing compared to the intrinsic value of all these options. Randy, anything you want to add here? I know you don't do a lot with ESOPs, but you have dealt with concentrated stock and risk positions in the past. And any general thoughts for people out there who are sitting on positions like that are deeply in the money right now?
I agree with your comment about is essentially a stock. I mean, we do deal with this a lot on a macro basis within SWAN as well as individual overlay programs. So yes, we have people come into us on a regular basis with a stock position and say, what should I do to risk it? And we do customized analysis and coming up with hedging techniques. So I just go back into the same thing that we do as a firm is if you've got something that's deep in the money that's a stock, then that would fit into whether or not something like we do at SWAN would be beneficial. Of course, that would be based on your own risk reward and what kind of effort you want to go with, try to mitigate some of that appreciation that you've experienced in the individual stock or the market in general. So I would just go back to, finding a manager that has a program that's consistent with your risk tolerance and what your goals are.
All right, we're coming up against it. We got time for, I think, one more. If we don't get to yours, I apologize. We'll get to you on a future episode. I got one here. This comes from Kevin D. K. Diddy. I like that. I think he actually wrote into one of our other shows, but I wanted to feature it here as well because it's a question that probably comes up with some of our listeners in this program. He writes, hey, hi, Mark. Love your shows. Well, there you go, Kevin. Good way to get featured is always to spread the love. He goes on to write, my question. What happens to my options if the underlying gets halted permanently? Would I ever be able to close them? I'm remembering a Sino Forest from a few years ago in Canada. The stock got halted pending a fraud investigation and never came back. I'm worried that I won't be able to cash in on my BABA puts. And this is from a few months ago. Hopefully he did by then. BABA, of course, has turned off quite a bit. Thanks, Kevin. Good question, Kevin. That's why I wanted to feature it here, because it is an interesting one. I'm sure a lot of our advisors in the audience and asset managers can remember times when names get halted, and sometimes when those things happen or these weird aberrant corporate actions develop, what happens to the derivatives on those products can become a somewhat confusing thing. In this kind of scenario, things usually get halted pretty briefly, and if that happens, the option's halted as well. You can't really do much with it. If it goes on, like in this case, this Sino Forest, and when I researched this after he wrote in and looked it up, and this did actually get shut down for quite a while. Eventually, the time frame I think varies depending on the situation, but eventually you're going to get some sort of determination from the OCC as to what happens with those listed products. There'll be some eventual strike settled on or some sort of guidelines they will provide, and that will determine essentially what the value is of those options going forward, what you can do with them, what you can sell with them, exercise them for, etc. So you're not completely out of luck. It's not an enviable situation by any means, but you're not without options, pun intended. You will get some sort of determination. And if you're in the case of someone like we were just talking about with deep in the money calls or things like that, you should be able to probably get some sort of strike. You can exercise them and know what you're going to get, or get something like that. Get some determination that will give you some sort of clear guidance. When that will come down, that I can't say. It really is up to the individual scenario and what the folks like OCC, how long it takes them to determine that. So yeah, not an ideal scenario by any means, but hopefully if it happens to you, you won't be completely left twisting in the wind. Mr. Randy, we'll go to you here one last time for the questions on the office hours. Has this scenario ever happened to you? And B, what's your take on what to do if indeed your options are halted, sometimes permanently?
It does not happen to me. The only event that I can remember was actually after 9/11, where they closed the market for a week, and that was not obviously based on an individual stock, but the entire market was closed. I didn't have any option positions that would have expired during that week, so I don't really have an example to say how that was actually treated. It is an interesting question that I get asked a lot, and I always kind of pose that. If you have a 9/11 scenario or something even worse at some point where the market, for whatever reason, can't even open up for a longer period than a week, how would they treat all those types of those options that may have actually missed their settlement date? And I guess what you said earlier, the OCC would have to come in and figure out some method of valuing the option in that event.
I don't envy their task in that scenario. And then what you mentioned, of course, 9/11 being a huge macro shock, and it was doubly dangerous for options traders because, like you mentioned, it rolled through expiration, which is an event no one's ever seen before when the market is shut down through expiration. So positions you may have thought were hedged, hedges you had on went away, all sorts of crazy things. And as a result, there was a lot of unanticipated risk coming into the market that next week when they finally opened. People had naked deltas and naked risks they hadn't foreseen because they were hedged, and they thought they were. They had other offsetting positions that went away through expiration. Maybe one leg or the other leg did, and it really was, from a risk scenario, extremely dangerous, in addition to all the other, of course, macro political effects of that event, that one particular area in terms of the expiration and being shut down through that was extremely risky. So, of course, we've seen a lot of disaster recovery things in the industry post 9/11 to help deal with this. And hopefully this is less of an issue going forward. But interesting question. Anything you want to add here one final time, Mr. Kavanaugh, before we close up the office hours for this episode?
No, and I do have to run. I'm hopping into a meeting. But like Randy said, it's never happened to me or anyone at RCF. And just to kind of mirror or echo what both of you said, the OCC is transparent in their determinations. You would go to their website, type in the symbol, and it generally shows you a sheet of what will happen, or an announcement of when they expect whatever the ruling is going to be on that underlying option. But yeah, I don't. It's never happened to me. September 11th, as Randy pointed out, is probably the closest it's ever happened to us. But we've never had that issue. So, and I do apologize. I got to run right now. I'm heading into this meeting. So
no problem, sir. The office hours are closed anyway. Head on over to RCM Wealth Advisors to learn more about what Mr. Kavanaugh and the team are working on over there.
Thanks, guys. Thanks, Randy. Thanks, Mark.
All right, and he has to run, and indeed we have to run too. We squeezed in as many of you folks as we could, so you can't get angry at me anymore if we don't answer enough questions, because we answered a lot of them here. There's still more to get to. You guys love your questions. We love hearing from you guys. Keep them coming. Send them to us, twitter.com/options, facebook.com/theoptionsinsider, questions@theoptionsinsider.com if you'd like to use that antiquated technology known as email, or surf on over to our website, of course, and leave us a comment or use the feedback form there. Or, of course, you can hit up Randy, the guys over there at Swan Global Investments as well. They'll be more than happy to answer the question, and perhaps even if it's an interesting one, bring it over for us here to chew on the old program as well. And speaking of Randy, before we wrap up here today, Mr. Swan, you guys are always working on interesting stuff. While we were talking here, I had a chance to look over this hurricane summer squall or the start of the hurricane season. A very interesting blog entry. If you haven't checked it out, listeners, surf on over to Swan Global Investments and search for it, or just type in summer squall or the start of the hurricane season. I think we'll also link to it on the Options Insider as well, because it's kind of an interesting analysis of what exactly is going on in the market right now, and got some great data and some graphs on sudden corrections and VIX spikes. So check it out over there if you haven't done so already, listeners. And Randy, in addition to some cool blog posts, what else is coming down the pike over there at Swan Global Investments?
The most recent announcement that I can mention, and I honestly can't remember if I mentioned it last month, but we launched our CIT program. So it's supposed to be a lower cost than mutual fund opportunity for people to invest in kind of retirement type products that has the fiduciary kind of wrapper around it, but it's also supposed to be on a lower cost basis. So those are the two benefits of the CIT program. We're pretty excited about that, mostly because I'm pretty sure that I can say that there's probably no one else has a CIT that is based on options. So it was very fun. It was very enjoyable for our investment management and our trading team to come up and develop the models based on, historically the kind of traditional 60-40 portfolio and all the variations around that. So we're pretty excited about that. And we launched it, I think it was actually in August, and we had a good first month in terms of assets that came in the program. So we're pretty excited about the opportunity.
Well, that's great to hear. Listeners, surf on over to Swan Global Investments to learn more for yourself. Check out the blog and everything. Of course, while you're there is a contact button and a send a message now button, so you can hit that if you don't want to waste time rating to the show and having it get to Randy or vice versa, and send it over there to Randy directly, and you guys can chat or he can answer it for you. And then, of course, if it's an interesting one, we can always feature it here on the program as well. We love to hear from you guys. And on behalf of Randy and Mr. Kavanaugh, and indeed myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show, and of course, for sending in such great and varied questions. Keep them coming, and we'll see you next time right here on The Advisor's Option.
The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.